Hello everyone and welcome to another property overview video. My name is Nadal Rashid and it is my pleasure to be bringing you this overview video on a project that we've been working on for a while. It's at 18 Edward Road in Ridgehaven here in South Australia. It's in a very desirable suburb, and today I want to run you through all the details from top to bottom. Now, if you were to jump onto realestate.com, you will see an ad for this project. So just to give you a high level overview, it's a 1-3 site. They're all Torrens titled house and land packages being built by Lofty Homes. It's a private developer who is a client of ours, and I want to run you through just some of the highlights. Now, I'll start with the area itself. So to give you a location map of where this is, we'll go back to the map view. If I was just to sort of zoom out a little bit, there is the site here. So it's on the corner of Edward Road and Bayview Crescent. Number 18 has been split into 3 pieces. In terms of location, it is minutes away from the St. Agnes Shopping Centre, which you'll find here on Northeast Road, and Modbury, the Westfield Tea Tree Plaza Shopping Centre, which you'll find on the corner of Reservoir Road and Smart Road, as well as the Modbury Hospital, which has also been upgraded in recent years. So in terms of location to close and proximity to close amenities, you've got major shopping centres, a hospital, you've got the O-Bahn, which takes it from Modbury down to the city, you've got shopping nearby, you've got highly desirable and sought after schools in the area. So it ticks a lot of the boxes that we look for in family friendly areas. The benefit of this as well is it's close proximity to the city. So you're well within, that 15 Ks of the Adelaide CBD. And again, it's just a short jump on the O-Bahn, which is Adelaide's version of a bus on a train track, and takes you straight into the city within, 15, 20 minutes. So it's a direct route into it. Just to show you the site, this is what it looks like at the moment. So the house has been cleared. The land has been divided and registered. So we have planning consents from the council to start developing. So it's a matter of once we get on site, we can break ground and start building straight away. So to show you what's proposed to be built on the site, this is Edward Road here. And then you've got 3 residences. So as I mentioned, they are Torrens titled. So they're all independent of each other. They can be built independently. They got independent services, independent everything. So there's no community titles or strata or body corporates or anything like that. So the houses themselves, they're going to be sitting on approximately 238 to 257 square meters of land. The house designs are approximately 145 square meters. So, and they consist of 3 bedrooms, 2 bathrooms, a single garage, and an open plan living area. So as you come through the house, you've got the 2nd bedroom to the front. And mind you, these all do vary from plan to plan. So they're kind of mirror imaged, but I'll walk you through one of them anyway. So as you come through, you've got the 2nd bedroom at the front with a built-in robe. And as you come through, you've got the main bathroom, which is accessible by, I guess, the whole house at the front, and that's got a bathtub with a shower, a toilet, and a basin. Now, as you come through, there's a little opening which has a linen cupboard, as well as access to bedroom 1 and bedroom 3. Now, bedroom 1 has a walk-in robe and an ensuite, private ensuite with a shower, toilet, and basin as well. And bedroom 3 has a built-in robe. Now, this does have a French-style laundry, so you'll see 2 opening doors with the laundry, which has a provision for a washing machine, dryer, and it's got a laundry trough in there as well. So you'll come down 3 stairs. There is a slight slope on the block, so it slopes downwards, and what that means is you'll obviously have some views looking out from the back as well, because it's obviously on a slight slope. However, as you come through, you've got the kitchen, and it's got a walk-in pantry to the side. So generous sized pantry. Obviously, you got your provisions for all your appliances and and your fridge and an island bench top, which opens up onto the living and meals area. There is also a veranda at the back, and that's all inclusive as part of the build. So they are going to be 3 houses. 2 of them are going to be adjoining. So if I go back to the site plan, you'll see residence 1 and 2 have boundary walls, so they are butting up against each other, and the garages are to the side. And residence 3 is a little bit more independent, where you've got the garage and the house as a boundary build, but then you've got the some access from the other side as well. So you've got so the house is being built on the boundary. However, you've got the garage on the other side, which has a little bit of room on the side. I mean, just to be able to get things like bins out and lawnmower in and out and things like that. Otherwise, the garages will have doors which give you access to the backyard as well. So you don't have to take the lawnmower through the house to be able to cut the grass at the back. Now, these are going to be built with a turnkey inclusion, meaning they're ready to move in. So that includes all your appliances, your floor coverings, your window furnishing, your stormwater, letter boxes, TV antennas, clotheslines, the whole lot. So it's a turnkey product, which means we get the key from the builder and we can give it straight to you to move in, or straight to a tenant ready to occupy and start renting and living there in that house. So what I would like to do is just show you some of the numbers, because as any investment opportunity, we always like to assess it based on its potential returns. Yes, having a nice house is a benefit. And in today's world, especially with the way the economy is going, it's, having your money parked in assets is way better than having it in cash or anything else. And properties has proven itself time and time again to be one of the better asset classes when it comes to, things like weathering some of the economic turbulence that we've been feeling. Especially, COVID was a great test, which showed us how properties were always going to be quite resilient to things like pandemics and things like that. Because the reality is people needed a house to live in or a roof over their head. So in terms of the financials, just to give you a bit of a breakdown, these are going to be done as house and land packages, where they are going to be, the total price is going to be at $599. Now, $275,000 is attributed to the land component, and the remaining amount is going to be on the build. So approximately $325 on the build. Now, the way these are done, so I'm going to go through a forecast with you, and we're going to break down the capital expenses, our annual income expenses, and our tax and market factors. So when we look at the capital expenses, this is broken down into three main costs: our purchase costs, our loan costs, and the improvement and selling costs. Now, these don't all apply at the same time, but I'll run you through them. So the property value in 2023, we're working on a $599,000 value, as well as a $599,000 purchase price. Now, for your due diligence, we would always recommend getting a building inspection done at the time of completion of the build. Although they're brand new, we still want to be able to see what the condition of the property is once we receive, in case there are any building defects that we can obviously get rectified within that maintenance warranty period. So the cost of that's going to be approximately $450. The settlement costs, so this is your upfront cost that you're going to need to pay. We've worked on the assumption of a 10% deposit. Now, obviously, you can do this with a lesser deposit if you're a first home buyer or you're an owner occupier. And in some cases, depending on your income situation, you may need a bigger deposit. If, for example, you're self-employed and you're doing a low doc loan, you might need a minimum 20% deposit. But for the average person, we're working on a 10% deposit, which is going to equate to $59,900. Your second biggest cost is going to be your stamp duty. Now, the benefit of doing a house and land package is you only pay stamp duty on the land portion, which in this case works out to $12,500. So if I was to look at the stamp duty on a $275,000 block of land, that works out to $12,556. Whereas if you were buying this as an established house at $599, you'd be paying $32,000 worth of stamp duty. So we're saving well over half just by doing this as a house and land package, because you're buying something that's undeveloped. and obviously you're going to have to, there's going to be some holding costs, which kind of evens out by the time it's fully built. However, you still work out a little bit better off by building rather than paying for an established house on completion in terms of stamp duty. Now, the third cost you're going to incur is going to be your legal costs, so your settlement and your conveyancing costs. So conveyancers in South Australia will normally charge anywhere in that $600 to $800 range. We've allowed $1,000 in case there's any searches or any further admin work that needs to be done, and that should cover you for the settlement of your property. So when you add all those up, your total upfront cost is going to be approximately $73.5K. Right, so that's what it takes in order to purchase one of these properties. Now, obviously, that can come from cash or from equity. So, for this example, we're just assuming that this is going to be a cash injection, which is going to be just under 74K. Now, your loan costs is separate to your settlement costs. Now, depending on the loan product that you go for, because in some cases, there are loans which have a zero application fee, zero package fee, there's no fees with them, and you can get away without paying anything. However, if you're going to go for a package of some sort, most banks would normally charge you about $395 or $400 for something like an offset account, some credit cards alongside with it, and some special accounts to just as part of the package. And because in this example we've used less than a 20% deposit, we're also assuming you have to pay LMI. So LMI stands for Lender's Mortgage Insurance, which means if you are putting less than 20% deposit, the bank takes out insurance to protect themselves in the event or in case you ever default on the loan. However, what they charge that cost over to you. So between the LMI and your setup costs, there's about $9,200. So if you were to add the two together, you're probably looking at about 82 grand as a total injection from your end for this deal. Now, when we move over to the improvement and selling costs, now if this was an older established property that you needed to renovate or do some additions to, or any extensions or anything like that, we would normally input the value of what you've spent and the value that it's added to the property. However, in this case, because it's a brand new property, it's not relevant for this example. So we're going to leave this blank. The second section within it is the selling cost. Now, this only applies if you decide to sell the property. So what we've done is we've allowed 2.2% for an agent's selling commission. We've allowed $3,000 for advertising and $1,000 for legal fees. Again, the transaction costs when you sell property are quite expensive, so we don't recommend that you sell in the short term. And if you're buying, don't buy this with the intention of flipping in the short term either, because the transaction costs on the way in and on the way out are quite expensive, as you can see. So this is more suitable for a longer term buy and hold strategy. So that covers us for the capital expenses up front. The second section is our annual income and expenses. So that's everything that's coming in versus everything that's going out. So when we look at the rents of properties in the market in Ridgehaven, and I did a little quick bit of research before jumping on just to look at what the market rate is. There are properties, older properties, 3-bedroom, 1 bathroom going for $580 a week, 3-bed, 2-bath, $540 to $580 a week, 3-bed, 1-bath going for $570 a week. 3-bed, 2-bath going for $540 a week. So there are properties that are definitely in the high 500s, which are comparable. Now, seeing that ours is going to be a brand new property, there's going to be full inclusions. It's going to be completely brand new, which means no one's lived in it. It's a premium property. There is no reason why we can't be asking for that type of rent as well. However, to be conservative, I've taken a figure of $550 per week rather than the $580. So $550 per week is going to translate to about $28,600 in rent per year, right, in the first year. And then obviously we've got rent increases along the way. And for anyone who knows the South Australian market, the rate of increase in rent has been quite astronomical over the last few years. Our vacancy rate is so tight at the moment. We've actually got an undersupply of rental properties. So the more properties we can get on the market, the quicker we will solve our housing crisis problem. So you can be doing your bit as a landlord by offering someone a rental to give someone a home and a roof over their head. Now, the second part of our our income and expenses is our annual property expenses. So for this particular property, because we've got a lesser land component where we're only talking 238 square meters, we have worked on approximately $375 per quarter for our council rates. So $750 every 6 months, $1,500 per year, which is in line with what you'd expect from your council rates in the Tea Tree Gully Council. Land tax, we've kept it blank, assuming that this is going to be your first investment property, or you've obviously got investments in other states. If you've got multiple investments in SA, then it's probably worthwhile having a chat with your accountant to see what structure might be best for you to follow. However, for this example, we've kept it as zero. The building and landlord insurance, you're going to average approximately $800 to $900 a year. So we've just allowed $1,000 a year for our insurance. There's no body corporate, no repairs or maintenance, no cleaning contracts, no service contracts, no garden and lawn maintenance. So we can keep these costs zero. The only cost that may come up in the years to come would be repairs and maintenance. And as you know, any property is going to have maintenance over some time. But for your first few years, it should remain as zero. The letting fee is normally 1.1 weeks rent. So if we were working on 550 times 1.1, that's going to be approximately $600 for your letting fee. Your emergency services levy and your water supply is approximately $400 a year. And property management, we're looking at 8% on the rent collected. So when we look at so this covers us for our property expenses, and this will be calculated in the next screen over. The loan component. Now, in this case, we're working on an interest-only example. So assuming that you've got a home loan, that's the debt that you want to try and pay off as quick as possible. And your investment debt is normally tax-deductible debt. So that's the one that you want to try and obviously not be too quick in paying down, especially when your loan repayments are quite high on all your loans. So the reason we recommend this is because your investment debt's tax deductible, so you can claim the maximum amount of deductions through your investment property, whilst looking out for your cash flow. Because if you are having to obviously make a big portion of principal payments, then that portion there is not going to be tax deductible. That's assuming that you're on an average income. If you're on a higher income and you've got enough disposable income to be able to cover that, then by all means you can as you please. If you want to set it up as principal and interest, you'll probably even get a cheaper rate. Now, the loan term we've done is a 30-year loan term. The loan amount, we've basically done a 90% LVR, so 90% of the value. The interest rate, we've taken an average of 5%. So obviously that can go up or down. In recent years, we've seen this in the 2s. Now we're looking at the 5s. It could potentially go a little bit more. But, when we average it out over the longer term, we're going to work with a 5% average interest rate. Now, the last section is our tax and market factors. So in terms of the depreciation, this is based on the building component. So there's two parts to the depreciation. Your first part is on your fixtures and fittings, which is things like your carpets and your appliances and the things that depreciate at a higher rate. And then you've got the actual building component of it, which would normally depreciate at 2.5% over a 40-year period. So you get 40 years worth of depreciation, but in the first 5 to 10 years, that's where you get the maximum amount. And this is why we start off with a higher figure, and it generally bottoms out at around about 2.5% of the build value over that 40-year period. The second part to the section is the market factors. Now, there's two parts to this. The first one is your capital growth. So I've been conservative and worked on a 5% average capital growth. Now, for those who've been following the market over the last few years, we've obviously had a lot more than 5% per annum. But when you average it out, and this is done based on 100 years worth of capital growth, South Australia would normally average around about that 7% capital growth, which means property should double every 7 to 10 years on average. However, with this example at 5%, you'll see in the next section over that the property doesn't even double in a 10-year period. So it is quite conservative. The second part to the market factors is CPI. Again, because we're in a different time at the moment, we're probably above that 3%, but we're using 3% as an average over the 10-year period. So we've got 3% for CPI. That means our costs of doing business is going to go up every year, and our costs and our capital growth is also going to go up each year. Now, the taxable income, this is based on what you earn. Obviously, as an $85,000 a year earner, you probably might not be able to service for the full amount on your own. So you might be doing this as a couple. So let's say there's two of you guys and both of you are earning 85K a year, or one's earning 85 and one's earning 70, let's say. All right, we can obviously, work out the numbers that way. If one person is earning more than the other, it would make more sense to have a bigger portion in the person who's paying more tax, just so that way you can claim more of the tax benefits. Obviously, in a court of law, everything is 50-50. However, for tax reasons, you can, obviously disperse more ownership to one party over the other for tax reasons. So when we look at our reports, this is what this property tells us. So if we're buying a property in 2023 for $599,000 and we're expecting a 5% capital growth over the next 10 years, that means in the next 10 years, we're expecting this property to go from $600,000 to $975,000. So we're expecting to make approximately about $375,000 in capital growth over a 10-year period. Now, when you average that out, that's about $37,500 per year in capital growth that we are getting without having to work for, without having to get out of bed for, without having to really make any effort towards, other than obviously buying the property and hanging on to it and not selling. So when you think about $37,500 per year, that's almost, a full-time income for obviously a minimal wage earner. So this is how you start the process of accumulating some assets that grow in value that will obviously help you, make better decisions down the track. So whether it's, selling an investment property to pay out your home loan in full, or whether it's a matter of just, paying down this property and then collecting passive income in the future, you start having more options around your financial future, but certainly moves you in the right direction. The second section in this is the loan and equity position. So because we've set this up as interest only, you'll see that the loan amount remains the same throughout this 10-year period, which means we're not really paying down the loan. The third line down will show us the loan to value ratio over the years. So although we're starting with a 90% LVR in the first year and only having, just under 60K worth of equity in the property, fast forward, 4 or 5 years, and all of a sudden you're sitting at 74% LVR and you've got $180,000 worth of equity. At this point there, you have the option of being able to go back and refinance this property, pull out some of that usable equity, and then go invest it into another property and then start building your portfolio. You may be able to do it even sooner, but if you wanted to be conservative, you might want to do one property every 2 to 3 years, just so you're building enough equity. Now, certainly in more recent years, some people have been able to build that kind of equity within 1 year, but that's not to say that's going to happen every single year. So it's not advisable for you to expect that you're going to make 150, 200 grand worth of equity in a very, very short space of time. Although it is possible in some in some markets, this is not what we are seeing out of this property here. Now, when we look at the third section down, which is the rental income, again, based on that $550 rent per week, that's going to give us $28,600 in rent per year. Now, as a yield, that translates to a 4.8% gross yield and a 3.8% net yield. So when we look at our expenses now, and we look at the loan costs alone on this is coming in at just under $27,000 per year. So $26,995 on our interest payments, and we've got $5,793 on our property expenses. So that gives us a total of $32,748 going out, but we've only got $28,600 coming in. So this means before tax, and I'm just going to skip a section here and go to the pre-tax cash flow. That means this property is actually costing us $4,148 per year, or if you work it out weekly, it's $80 per week. So if you think about this $80 per week, I mean, this might translate to a couple of times eating out, it might translate to a couple of memberships per week, whether it's Netflix and gym and some, Uber Eats or whatever it may be. So this is the cost of owning an investment property these days. Now, again, this cost has been sometimes a positive in more recent years where the interest rates was a lot lower. In the current climate that we're in, it's obviously going to cost you a little bit out of pocket. However, this is only the pre-tax cash flow, because remember, this now becomes a tax deduction for you. And this is what negative gearing is. So this $4,148 gets added to the depreciation that we have on the property. So the property is depreciating on paper, or approximately $12,000 in the first year. Plus, we had some lender's mortgage insurance that we had to pay earlier. And that lender's mortgage insurance is also tax deductible over the first 5 years. So when you take the total deductions for the year, you now have $18,000 coming off your taxable income. So if you were taking 18 grand off your taxable income, you're going to get approximately 30% of that back, which means you could expect to get $6,078 back from your tax refund. So that tax refund that you're getting will actually cover the initial shortfall that you had and still leave you with a positive cash flow of $1,930 or $37 per week. So as you can see, the property is doing three things here. It's giving you $37,500 worth of capital growth. It's helping you with, getting a big tax depreciation and giving you some tax advantages. And it's giving you a post-tax positive cash flow of just under $2,000 a year or $37 per week. So this money here, if you wanted to put it back into paying down the principal, you can, or if you wanted to put it into your own home loan and speed track your loan repayments on your own non-tax deductible debt, you can. This is pretty much your passive income from your investment portfolio. So as you can see, there's a lot that goes into making a property investment profitable, and there's a lot that is required from you as an investor before you can start making a passive cash flow. However, property is, in my opinion, probably one of the best ways to go out there and build a passive income, because once you've set up a portfolio, once you've got that capital growth happening, it's all happening whether you do anything about it or not. You can go to sleep and still make money. And this is the beauty about what we do, is that we're obviously educating and assisting and guiding people on doing all this. So how do we fit into the picture? Obviously, we run a buying agency which allows and helps people to find these opportunities. We can help you with, obviously the whole process from, contract signing to finance approval to land settlement, construction, handover, even the property management. And we have a great property management team that excels in this area. We specialize in these type of properties, and all the way through to helping you make that passive cash flow. So allowing you guys to start building that second income stream and start taking control of your financial future. So if this sounds like something you would like to do for yourself and for your family, feel free to reach out. You can either go through the normal process of applying through something like a realestate.com and going through that process there, or you can just reach out to us direct. I'm sure you can find our details anywhere on the socials, and we would love to be able to help you out. So hope you got some value out of this video. As always, if you have any questions, feel free to reach out, and I look forward to reconnecting on another video. All right, take care and all the best.